Welcome to The Advantage Investor, a Raymond James Limited podcast that provides perspective for Canadian investors who want to remain knowledgeable, informed, and focused on long-term success. Today is May 3rd, 2024. I'm Chris Cooksey from the Raymond James Corporate Communications and Marketing Department. And today, Head of Investment Strategy, Neil Linsdell, returns to the podcast. Welcome back to The Advantage Investor, Neil. I hope you're doing well today.
Yeah, great. Thanks for having me again.
Excellent. Now, January was the last time you visited. We recapped 2023 if people want to go back and listen to what we were saying then. And I do believe one of the things we talked about was inflation and how it was trending back towards the level that they want, around 2%. And I think we were talking about it at the time. There were people out there saying they were expecting 5 or 6 rate cuts in the US. January isn't that long ago, but I do believe things have changed since then. And you recently published your Q2 update. And so why don't you run through the highlights to that?
Sure. Well, you're right. Expectations on interest rates have shifted a lot in the US, but in Canada, we're trending pretty much in line with what we expected. So we can take a look at some of that divergence. So yeah, as you said, we did publish our Q2 update a couple of weeks ago, and the key takeaways are that we're still looking for GDP growth to slow in both Canada and the US, and for interest rate cuts on both sides of the border. Economically, in Canada, the year did start out relatively well, but February was a bit weaker than consensus expectations, and the flash estimate for March points to a slowdown in the momentum leading into the second quarter. The Bank of Canada did recently upgrade its 2024 full-year GDP forecast to 1.5% growth, up from 0.8% was their forecast in January. So there's a little growing optimism, but we're still looking at a recession this year, likely in the second half, although that could hinge on how quickly the bank lowers interest rates. Now, when I say recession, we're still talking about a mild recession, so modest contraction GDP. Do you expect to see further increases in the unemployment rate? Nothing dramatic, but we're still watching for these high interest rates putting pressure on consumers, and that's still working its way through the economy with those, infamous lags.
Yeah. And so I imagine this pressures business as well, and I assume that's why you expect maybe the unemployment rate to be impacted?
Yeah, exactly. So businesses are growing more cautious with this about their revenues. And as the population in Canada is growing dramatically, job growth is not just keeping pace with that. So in fact, if we looked in the last Business Outlook survey, and concerns about sales are actually the fastest growing concern among the businesses, while issues like we've talked before about labor shortages, supply chain, cost pressures, those are all in decline. The labor market isn't as tight as it used to be, and the unemployment rate in Canada was last reported at 6.1%. So that's up from about 5% last year. Again, nothing to panic about. The long-term average is around 8%, but we are seeing a deterioration. So as the unemployment rate starts to pick up a bit, and there's more uncertainty, and that continues to spread.
All right, and our friends to the south in the US, sounds like their environment is markedly different, shall we say?
Yeah, absolutely. The US has been much more resilient in many respects. GDP is stronger. We had 3.4% in Q4. Weakened a little bit in Q1, 1.6%, but still a very decent growth there. And their unemployment rate, we actually had a new jobs report out this morning. So they have a much lower interest rate an unemployment rate, 3.9%. That's up a little bit from 3.8% last month. But it's still a relatively tight market. And that might be one of the reasons the US is having a little bit more challenging time with inflation. The US inflation rate has actually picked up recently, such that it's actually started to raise some concerns that the US might start hiking rates again.
Oh, no.
Well, a lot has happened since last week. So the last number CPI we had was 3.5% in the US, core PC 2.8%. Those were above expectations and stubbornly sticky. Jerome Powell, the chairman of the Fed, made some comments this week that inflation still remains too high, obviously, but that the Fed sees that the current rates are sufficiently restrictive and that it's unlikely the next policy rate move would be a hike. So that took the prospects and the potential for rate hikes off the table. But it's clear that the Fed, has a time. They could take some more time, watch the data before committing to reducing rates. Right now, expectations are generally for one rate cut this year. Our U.S. team is forecasting two. And interestingly, though, that weak U.S. jobs report that I just mentioned that came out this morning, we actually had non-farm payrolls growing only by 175,000 in April. So the expectation was for 240,000. So that means that, thinking that the economy is weakening a bit, employment's not as strong, and that suddenly raised the potential, the enthusiasm that the Fed might have more leeway to cut sooner. So sentiments can shift on a dime here. So
Fair enough. Fair enough. Now, we had our colleague Harvey Liddy on the last episode, and he was talking about his expectations around bank cuts in Canada. And he was suggesting it might be June. So I'm going to assume that the inflation story is a little bit better here in Canada because of these rate hikes, or
yes. In Canada, we've seen relatively steady progress on inflation. And CPI, total CPI has actually been below 3% for 3 months now. So as it moves down to that magical 2% level, and is arguably already within the 1% to 3% comfort band that the Bank of Canada has, you have to remember that there's CPI trim, CPI median. So there's different ways to calculate inflation in Canada, and each one of them excludes certain different volatile items. But we did talk about this. We published some more detail in our April monthly Insights and Strategies report. You can go back and take a look at that. But basically what we explained, that if you remove the impact that high interest rates are having on mortgage payments, we'd already have an inflation rate that's below the Bank of Canada's 2% target. So think about that. So if high policy rates are meant to reduce inflation, but they're actually adding to inflation by increasing the shelter cost component of our inflation measure, wouldn't you think that we should be lowering interest rates at this point?
Yeah, that would sound good to me. As I've said many times, my variable rate mortgage would enjoy the reduction of the rates. Do you think then, as our colleague Harvey does, June is the time it starts?
Yes, I'd agree with Harvey on that one. The market right now, the market seemed to be torn between expectations of the easing cycle in Canada starting either June or July. But I think the bank can and should, as we're mentioning, lower the rate starting in June. So don't forget that we're already seeing pressure on the economy, and the longer that you wait to lower the rates, there's more mortgages that are going to end up renewing at higher rates than they could have been. There's more pressure on consumers. Plus, as we explain in our report, inflation is already at or below the target rate. If you make some very reasonable adjustments on how you measure it, then there's no reason for the overly restrictive policy that we have now. So yes, I would lean towards a June cut.
All right. We have a lot of snowbirds here, and they need US dollars. And if we start cutting rates and the US doesn't, how does that affect the currency right around probably the fall and that type of area when people start returning to their southern homes?
There's definitely a possibility that that's going to impact currency. So there's a lot of factors that go into foreign exchange rates, but the difference in interest rates is certainly influential. So we're looking at both the ECB and Canada to lower rates before the US at this point. And that, yes, you're right, that should weaken the Canadian dollar against the US dollar. But there's a few impacts here to consider. So If that does occur, what happens? You risk importing goods inflation to Canada. So anything that you import from the US at that point would make those products more expensive in Canadian dollar terms, and so that can boost inflation in Canada. But you also make Canadian exports more attractive to the U.S. market, right? Because they become less expensive in U.S. dollars. So that potentially helps GDP. So there's puts and takes to this. Ultimately, you don't want the rates to be too different. So the Bank of Canada governor actually commented on this week in front of the House of Commons Finance Committee. And he admitted that there is a limit to how far the U.S. and Canadian interest rates can diverge, but that we're certainly not close to that limit right now. So I take that as a signal that the Bank of Canada is not going to hold off on rate cuts just because the Fed might not be ready to start their easing cycle.
All right. Now, GDP, to summarize, I guess, GDP has been stronger in both countries, stronger than expected. It is weakening. You're still looking for that mild recession coming up towards the end of the year. And there likely will be further increases to the unemployment rate. Do I have that all correct?
Yeah, exactly.
Okay.
And if we go back and we look at the differences from what we wrote just 3 months ago in January, now we think the U.S. will avoid recession. So that's probably some of the big things. And we're looking more towards a soft landing scenario because we have seen, significant strength in GDP there. And that for the most part, the expectations for rate cuts in the US are lower. So less rate cuts pushed out more towards the end of the year.
Okay. So that's got to be influencing equity markets in some way. And we're probably, or not probably, we have been on quite a run since the fall, October of last year. And you let me know that April was our first negative month since then. So what does that portend?
Yeah, well, that's right. I mean, both the TSX Composite and the SP 500, they were down in April, but you got to remember that was after 5 positive months. So
right.
TSX was down 1.8% in April. S&P 500 was down 4.2%. Now, again, you have to put that into perspective. The SP 500 was up around 27% from October, and the TSX was up around 20%.
Okay.
Right? Yeah. So if you had to expect some kind of release, some kind of pressure taken out of the system here, and we've been talking about increased volatility given the significant returns that we've seen over the last year or more. And remember volatility works both ways. So this is all relatively normal. You're going to get this type of volatility in the stock market. But now, as we're in the thick of earnings season, we're looking at earnings, and for the most part, earnings have been strong. Now, the fact that rates may stay higher for longer, at least in the U.S., that can weigh on equity valuation multiples. So we do only expect modest improvement really on equities through the end of the year. But with that soft landing scenario, still good economic growth, overall good earnings, the multi-year outlook remains quite positive. And if we look at valuation multiples, so valuation multiples in Canada, they've been more conservative in the U.S. as they typically are. Right now, P multiples on the comps is around just over 14 times, just around 20 times in the U.S. So that's higher. A lot of that has to do with the Magnificent Seven. EPS growth expectations in Canada are also lower, around 5%. 2024 over 2023, while in the US it's about 11%. So, well, there's always a lot of give and take in the markets. You can't forget that timing the market is difficult, if not impossible. So, it's best not to try and get fancy and just to stick to good quality investments that serve you well in the long term.
As you say, it's important to really look at the whole story rather than the one sort of negative issue or the one overly positive issue. And I'm going to assume you agree with me that the best person individuals can talk to is their Raymond James advisor.
Yeah, you took the words out of my mouth. Yes.
Perfect. Now, you touched on mortgage rates earlier. In the recent federal budget, we saw a lot of focus on housing, and obviously the press has been all about housing affordability and whatnot. You have published a few commentaries on this subject in the last few months. Do any of these initiatives affect your forecast?
Well, I mean, you're right. We have been writing quite a bit about the housing crisis in Canada, which, it's really about both availability and affordability. Although it's great to see initiatives to support housing, we really don't see that much immediate relief. The problem is really between supply and demand, right? So last year, we saw the population of Canada grow by 1.3 million people. So this is really unprecedented growth, and all those people need somewhere to live. On the other hand, we have seen the number of housing starts in a steady decline since 2021, and even the CMHC update from this week forecasts that housing starts will decline further in 2024, below the 240,000 we saw in 2023. So, and that's although the population growth continues unabated, and the government's plans to start reining in that population growth seem to transition in from 2025 to 2027. So, back in October, when we first wrote about the housing crisis, we estimated that we need to build roughly 650,000 homes per year. That was starting immediately in order to move towards the government's affordability targets. So 6 months later, situation only looks worse. So I don't see any immediate relief, and it takes quite a while to build new homes, especially multifamily units or apartment buildings, and you need to coordinate that between multiple levels of government, right? No small feat. So given that any kind of government initiatives will take time to trickle into the market, and that the interest rate environment uncertainties not necessarily conducive to developers taking on additional risk, the supply demand balance has little chance of improving in the very short term. So I'm not sure we even have enough construction workers to achieve the growth rates we need to hit those targets, actually. So it's definitely something to watch. We don't see any short-term fixes. So unfortunately, so good to see some initiatives on that theme, but not a lot of immediate help, unfortunately.
Well, that was fantastic news, Neil. Thanks for that.
End on a high note. Yes, great.
Yeah. Well, I'm not a math guy, but even I can see that equation doesn't work out. So anyway, hopefully shovels get into the ground, as they say. Just want to thank you for taking the time today, Neil. Really appreciate me stealing or you allowing me to steal some of your time, and we'll talk again next quarter.
Great. Thanks a lot for having me again.
Alrighty. Reach out to us at theadvantageinvestorpod.ca. Subscribe through Apple, Spotify, or wherever you get your podcasts. Please contact your advisor with any questions you have. Thank you for taking the time to listen today. Until next time, stay well.
This podcast is for informational purposes only. Statistics and factual data and other information are from sources Raymond James Limited believes to be reliable, but their accuracy cannot be guaranteed. Information is furnished on the basis and understanding that Raymond James Limited is to be under no liability whatsoever in respect thereof. It is provided as a general source of information and should not be construed as an offer or solicitation for the sale or purchase of any product, and should not be considered tax advice. Raymond James advisors are not tax advisors, and we recommend that clients seek independent advice from a professional advisor on tax-related matters. Securities-related products and services are offered through Raymond James Limited, member of the Canadian Investor Protection Fund. Insurance products and services are offered through Raymond James Financial Planning Limited, which is not a member of Canadian Investor Protection Fund.